Welcome to the deep dive. Ever wondered why some businesses are, C Corp and others LLCs? It's not just alphabet soup. It's actually a foundational decision. It impacts everything from how you pay yourself to, well, how much tax you owe. Today we're taking a deep dive into the surprisingly fascinating world of business entity choice. We're talking the tax and legal implications that every entrepreneur really needs to understand. You've given us a fantastic stack of sources on entity formation, liquidation, all that good stuff. And our mission today is to cut through the complexity, We're here to distill the absolute most crucial insights, helping you grasp not just what the differences are, but why they're such game changers for a business owner like yourself.
And that's exactly it. I mean, the initial choice of your business entity, it can have these profound long-term impacts. It shapes everything from daily operations to your entire tax landscape. It's truly one of those significant decisions a new business makes. Seriously.
All right, let's kick things off at the absolute basics then. When you're setting up shop, you're basically juggling two big considerations, the legal structure and the tax structure. And as you'll see, they don't always align as neatly as you might think. On the legal side, you've got your main players, the sole proprietorship.
Just one person, usually.
Right. Then a partnership or joint venture, a limited liability partnership that's an LLP, a limited partnership, a limited liability company, an LLC, and then the corporations, C corporation and S corporation. Quite a list.
It is. And they have some pretty stark legal differences.
Let's start with the number of owners. A sole proprietorship, like you said, just one person. A partnership needs at least two.
Right.
An S corp, interestingly, can have up to 100 owners, but there are specific rules about who can be an owner. Think individuals mostly, not other companies.
Yeah, those eligibility rules are key for S corp.
Then there are formation formalities. Want to be a sole proprietorship?
Basically just start doing business. No special paperwork needed with the state, generally.
Easy enough. But if you're setting up a corporation, C or S, you're looking at filing articles of incorporation with your state.
Definitely more formal. LLCs and LLPs also have their own state filing requirements, like articles of organization.
Okay, maybe the most critical legal difference, and the one that gives most new business owners pause, is the liability of owners.
This is a huge one.
In a sole proprietorship or a general partnership, you face unlimited personal liability.
And that means, well, it means everything personal could be at risk if the business fails or gets sued. Your house, your savings.
Scary stuff. But for LLCs and corporations, there's usually a protective barrier. Owners are generally not personally liable beyond what they've invested.
Right. Your risk is typically limited to the money you put into the company itself. It's a major reason people form these entities.
What about LLPs and limited partnerships?
Well, for LLP partners, liability is usually limited too, protecting them from, say, another partner's screw-up, though they're still liable for their own actions. And in a limited partnership, the limited partners, the ones not managing day-to-day, are generally only at risk for their capital contribution.
Got it. Then there's management. A sole proprietor runs the show directly.
Yeah.
In a corporation, things are more formalized. You've usually got a board of directors overseeing things, appointing officers for the daily grind.
And partners can manage directly, or they might appoint a managing partner in their agreement.
Finally, transferability of ownership. How easy is it to sell your stake?
It varies a lot. A sole proprietor can sell the whole business pretty easily.
But partners
Usually need unanimous consent from all other partners to transfer their interest. It can be restrictive.
Okay. And shareholders in corporations?
Generally, much freer to sell or transfer their shares, unless there's a specific shareholder agreement limiting that. Much more liquid, usually. So, if we connect this to the bigger picture, while these legal structures define how you operate and who's liable, your tax classification dictates how the IRS sees your income and expenses. And for federal income tax purposes, the IRS really only recognizes 4 core business entity types: the C corporation, the S corporation, the partnership, and the sole proprietorship.
And they each file different forms.
Right, exactly. Like a sole prop uses Schedule C on your personal 1040. A C corp files a Form 1120. Partnerships use Form 1065. S corp use 1120S. Different systems. Now, what's crucial to understand, and honestly where a lot of confusion comes in for new entrepreneurs, is that an LLC, well, it's not a separate tax entity in the eyes of the IRS.
Oh, okay. So how does that work then?
It's incredibly flexible. By default, it just checks a box to be treated as one of those 4 core tax types. So, for instance, if an LLC has 2 or more owners, the IRS usually just treats it as a partnership for tax purposes. That's the default.
And if it's just one owner?
If it's one owner who's an individual, it's typically treated as a sole proprietorship by default. Income just goes on Schedule C of the personal return. And here's a really powerful takeaway. Any unincorporated entity, like an LLC, can actually elect to be treated as a C corporation or even an S corporation if it meets the requirements. It's called the check-the-box regulation.
So you get legal flexibility with the LLC structure, but can choose your tax treatment.
Precisely. As we dive deeper now, we'll explore key tax characteristics like how you contribute property, how profits are taxed, what happens with losses, how you pay yourself, and what distributions look like, both while running and when you liquidate.
Okay, let's do that. So imagine you're starting your business and you want to put in some valuable property, maybe a building, some equipment, maybe just a big chunk of cash. How you get those assets into the business can have immediate tax implications. For C and S corporations, what's the main thing to watch out for there?
That's a great question because, yeah, you definitely don't want an unexpected tax bill right out of the gate. For corporations, the IRS has a specific rule. Think of it like a potential tax-free pass for contributions. It's called Section 351. It allows shareholders to transfer property to the corporation in exchange for stock without recognizing immediate gain or loss. But
There's always a but.
always a but with taxes. This pass comes with a strict condition. Immediately after the transfer, the shareholders who just contributed property must collectively own at least 80% of the corporation's voting stock and at least 80% of all other classes of stock.
80%. That sounds like a high bar.
It can be, especially if you have multiple investors coming in at different times. If you meet that control threshold, it's usually smooth sailing tax-wise. No gain recognized for or the corp basis just carries over. But if you don't meet that 80% control test when you contribute property for stock, then you do recognize gain or loss immediately.
Ouch. Okay, so that 80% control is key for corporations. What about partnerships? Is it simpler there?
Absolutely. This is where partnerships and LLCs taxed as partnerships really have an advantage in contributions. For partner contributions of property to a partnership in exchange for an ownership interest, there is no 80% control requirement. None.
Really? So even for a small percentage?
Exactly. You could exchange property for even a tiny 1% partnership interest, and it would still generally qualify as a non-taxable exchange, much more flexible. The partner's basis in their partnership interest usually just carries over from their basis in the property, maybe adjusted for liabilities, and the partnership takes the same basis in the property. There's also this interesting special rule for what we call built-in gains or losses.
Built-in gains. What's that?
So imagine you contribute property to a partnership that's already gone up in value before you contributed it. Let's say you put in land worth $100 that you bought for $60K. That 40 ag is a built-in gain. If the partnership later sells that land for, say, $110K, that initial $4K of gain, the pre-contribution part, has to be allocated only to you, the contributing partner.
Okay. That makes sense.
Right. And then the gain that happened after contribution, that extra $10K in our example, that gets allocated among all the partners according to the agreement. So what's really advantageous here, purely from a property contribution angle, is that the partnership or sole proprietorship usually comes out ahead. You're not stuck trying to meet those strict corporate control requirements to avoid recognizing gain right away on appreciated property.
Okay, that's super clear. Now, here's where it gets really impactful for most people, how the money your business actually makes gets taxed. This is a major, major differentiator between entity types. Let's start with C corporations. What's the big tax concept everyone talks about?
The big one, and often the biggest headache, is double taxation. It sounds exactly like what it is. Imagine your C Corp earns $1 of profit. That dollar gets taxed first at the entity level. The corporation pays tax on its taxable income.
And that's at the flat corporate rate.
Correct. Currently a flat 21%. Okay,
Yeah.
so tax number one. Then, if the C Corp decides to distribute that after-tax profit to you, the shareholder, as a dividend, it gets taxed again at the shareholder level on your personal return.
So it's like two tools on the same road to get the money to the owner. What do those shareholder taxes look like?
Exactly. For individual shareholders, qualified dividends get taxed at preferential rates. It's 0% for lower income folks, 15% for most people, and 20% for higher income taxpayers. But wait, there's potentially more. Some higher income taxpayers might also face an additional 3.8% net investment income tax, the NII tax on that dividend income.
Wow. Okay, so that 21% corporate tax plus potentially 20% or even 23.8% on the dividends. That adds up.
It really can. Now, one strategy C-Corps use is earnings retention. If the corporation keeps the profits inside the business for growth, reinvestment, whatever, then that second layer of tax, the dividend tax, is simply delayed until the profits are actually paid out.
So you kick the can down the road on the second tax.
Pretty much. which can be advantageous if you're focused purely on growth.
Okay, now let's shift gears to the flow-through entities partnerships, S corporations, sole proprietorships, and most LLCs. How does taxation differ for them? Big difference, right?
Huge difference. For flow-throughs, the key concept is single taxation. Their income is taxed only once.
Once. How does that work?
It happens directly at the owner level.
Hmm.
The business itself doesn't pay income tax. Instead, the income, losses, deductions, credits, they all flow through the business entity onto the owner's personal tax returns. And it's taxed when the business earns it, regardless of whether the cash is actually distributed to the owners or not.
So the profit hits my personal return in the year the business earns it, even if I leave the cash in the business bank account.
That's exactly right. The income is added to your other income, and it's taxed at your regular individual ordinary income tax rates, which currently range from 10% up to 37%. The allocation of income to owners in these entities is generally based on ownership percentages. So if you own 50%, you generally get 50% of the income or loss. However, partnerships have this unique flexibility. Their partnership agreement can actually specify different allocation methods based on other factors, like capital contributions or maybe sweat equity. S-corps generally don't have that flexibility.
That sounds way simpler than double taxation. But I know there's another big tax lurking for active owners and flow-throughs, the self-employment tax. Can you break that down?
Ah, yes, the SE tax. It's basically how owners of unincorporated businesses pay into Social Security and Medicare. It's currently 15.3% on technically 92.35% of your net self-employment earnings, up to the Social Security wage base for that part.
15.3%, that's hefty. How does it apply differently?
It is. For a sole proprietorship, pretty much all the net business income is considered self-employment income and subject to SE tax. Same goes for an actively involved partner's share of ordinary business income. In a partnership, it's generally all SE income. They pay the full 15.3% themselves.
Okay, so sole props and active partners pay SE tax on their earnings. What about S corp?
And here is the crucial, often the deciding factor for choosing an S corp. For an S corporation, the business's ordinary income that flows through to shareholders is not considered self-employment income.
Not at all, even for active owners.
Not the flow-through income itself. Now, the catch is, if you're an active owner in S corp, the IRS expects you to take a reasonable salary for the work you do.
Ah, okay.
That salary is subject to regular payroll taxes FICA, where the S corp pays half and you pay half as the employee. But any profit distributed above that reasonable salary comes out free of SE tax and FICA.
So that could be huge tax saving compared to a partnership or sole prop where all the profit is hit with SE tax.
Potentially massive savings, yes. It's a major strategic advantage for S corp, assuming profits are high enough to justify it beyond a reasonable salary. And just quickly, similar to C corp, flow-through owners can also face that 3.8% net investment income tax, but usually only if they are passive owners, meaning they aren't materially participating. Active sole proprietors and partners generally aren't subject to NII tax on their business income because it's SE income. Active S corp owners usually aren't either if they materially participate.
And there was one more deduction you mentioned for flow-throughs.
Yes, the Qualified Business Income, or QBI, deduction, Section 199A. This is another significant potential advantage. It allows individual owners of flow-through entities to potentially deduct up to 20% of their qualified business income directly on their personal tax return. There are limitations based on income and type of business, but it can effectively lower the tax rate on business profits quite a bit.
Okay, wow. Lots of moving parts there. So with all that laid out, which entity is the tax champion? Is there a clear winner?
You know, it's the classic consultant answer. It really depends. There's no single best for everyone. The most advantageous entity really hinges on a couple of key things. First, what are the owner's individual marginal tax rates versus that flat 21% C corp rate? And second, how much does the business plan to retain profits versus distributing them out to owners?
Okay, so walk me through that calculation. When might a C corp win?
A C corporation might look better if the business plans to reinvest most of its earnings back into the company. Why? Because you delay that second layer of tax on dividends. It can also be better if the individual owners are already in the highest personal tax bracket, say 35% or 37%. That 21% corporate rate looks pretty good by comparison, especially if distributions aren't happening soon.
Makes sense. And when does a flow-through usually win?
Well, if the business does plan to distribute earnings regularly, or if the owner's individual tax rates are lower than 21%, then a flow-through entity almost always comes out ahead because you avoid that double taxation. And again, we can't ignore the QBI deduction. That 20% deduction is a direct benefit for flow-through owners that C-Corp shareholders just don't get.
And within the flow-through world, S-Corp versus partnership.
That's often the tougher call. The S corporation's big draw is avoiding SE tax on distributions above a reasonable salary. That's huge for profitable businesses with active owners. But partnerships offer that incredible flexibility in allocating income, losses, and deductions. That can be invaluable if you have complex ownership structures or agreements.
Okay, let's try to make this concrete. You mentioned Don and Mary. Let's say they're starting a business, equal active owners, expecting good profits. Crucially, they plan to leave all profits in the business for growth. No distributions, no compensation for now.
Okay. Scenario 1. Don and Mary are both in the lowest individual income tax brackets, say 10% or 12%. Here, an S corporation is almost certainly the best choice. Why? The income only gets taxed once at their low individual rates, way better than the 21% corp rate. Plus, they'd likely get the QBI deduction, and the real clincher compared to a partnership. If they were a partnership, all that profit would be hit with the 15.3% self-employment tax.
Oof.
Right. With an S-Corp, that flow-through profit isn't subject to SE tax. So S-Corp wins handily here to minimize their current tax burden. Now, scenario 2. Same situation, profits retained, but Don and Mary are in the absolute highest individual tax bracket, say 37%.
Okay, big difference.
Huge difference. In this case, a C corporation likely becomes the most advantageous choice.
I would flip.
Because the C corp pays tax at that flat 21% rate. If they were a flow-through S corp or partnership, that profit would flow through and be taxed at their 37% individual rate. Since they aren't planning any distributions, that second layer of C corp tax is avoided for the time being. So paying 21% now looks much better than paying 37% now. The C corp keeps more cash inside for growth in this specific scenario.
That makes perfect sense how the owner's tax rate and distribution plans totally change the calculation. Okay, what if things don't go so well initially? What if your business has a rough start, loses money for a while? How losses are treated can make a huge difference, right? Nobody wants a loss they can't even use.
Absolutely vital question, especially for startups. Many businesses lose money early on. Now, generally, your ability to deduct losses is subject to several hurdles. You need enough tax basis in the entity, you need to be at risk for the amount of the loss, and there are rules about passive activity losses if you're not actively involved. We won't dive deep into those limits now, but they exist.
Okay, assuming you clear those hurdles, how do the entity types differ?
The biggest difference is, again, between C-Corp and flow-throughs. Flow-through entities, S-Corp, partnerships, have a major advantage here. Their losses flow directly through to the owner's individual tax return in the year they occur.
And that means?
That means you can potentially use those business losses to offset other income you might have, like from a job, or investments reducing your overall personal tax bill right now. It's an immediate tax benefit.
That sounds incredibly valuable, especially when cash is tight in a new business.
It really is. Now, even if a deduction is delayed by, say, basis limits, it's generally still better than the C-Corp situation. C-Corp losses, called net operating losses or NOLs, generally stay trapped inside the corporation. They get carried forward to offset future corporate income.
So no immediate benefit to the owner.
Correct. And worse, under current rules, those NOL carry-forwards can typically only offset up to 80% of the corporation's taxable income in future years. So the benefit is delayed and potentially reduced.
Okay, so flow-throughs are generally better for using losses. Is there a difference between S-Corp and partnerships here?
Yes, there can be. The partnership form often allows for deducting more losses sooner. It comes down to basis. A partner's tax basis and their partnership interest, which limits how much loss they can deduct, actually includes their share of the partnership's debt.
Ah, so borrowing money increases their ability to deduct losses.
Generally, yes. An S-Corp shareholder's stock basis, however, does not include the S-Corp's debt, unless it's a loan the shareholder made directly to the corporation. So, if the business has significant debt, a partner might be able to deduct losses that an S-Corp shareholder couldn't yet, simply because the partner has more basis.
Got it. Let's revisit Don and Mary, for example, too. They're forming a new business, expecting losses for the first few years. They have substantial basis, they're actively participating, and they have other income outside this business.
Okay. In this scenario, an S-corporation or a partnership is overwhelmingly the most advantageous choice. No question.
Because the losses flow through.
Exactly. If they were a C corporation, those NOLs would just sit there, carried forward, maybe only usable against 80% of future profits. The tax benefit is delayed, maybe for years. But with an S corporation or partnership, those losses pass right through to Don and Mary's personal returns. Since they have sufficient basis, and we're assuming they clear the at-risk and active participation hurdles, they can use those losses now to offset their other income.
So they get immediate tax savings when they probably need the cash flow the most.
Precisely. Big advantage for startups anticipating early losses.
All right, so you've built the business. Maybe it's profitable now. Maybe you weathered the early losses. How do you actually pay yourself for the work you're doing? This isn't just about getting cash, right? It's a critical tax thing affecting Social Security, Medicare.
Absolutely. How you structure owner compensation is key. Let's start with C&S corporations. Shareholders who work in the business can be treated as employees. They can receive a salary.
Okay, just like a regular job.
Pretty much. That salary is ordinary income to the shareholder employee, subject to regular income tax withholding. Crucially, the corporation pays the employer's share, that's 1/2 of the FICA taxes, Social Security and Medicare, on that salary. The employee pays the other half through withholding.
And the corporation gets a deduction.
Yes, the corporation gets to deduct both the salary itself and the employer portion of the FICA taxes it paid. That reduces the corporation's taxable income.
So the corp effectively splits the FICA burden with the owner-employee and gets a deduction. What about partnerships? Can partners be employees?
No, this is a fundamental difference. Partners legally cannot be employees of their own partnership.
So no salary. How do they get paid for services then?
Instead of salaries, they receive what are called guaranteed payments for services rendered. Think of it like a salary equivalent for partners. The partnership still gets to deduct these guaranteed payments, reducing the partnership's overall income that flows through to the partners.
Okay, but what about FICA? Does the partnership pay half?
No. Since partners aren't employees, the partnership does not pay the employer portion of FICA on guaranteed payments. Those guaranteed payments are considered self-employment income to the receiving partner. Meaning the partner has to pay the entire self-employment tax, that full 15.3% on those guaranteed payments themselves on their personal return.
Ouch. So partnerships don't share that FICA's tax burden like corporations do on salaries?
Correct. That's a significant difference. And just quickly, sole proprietors simply can't pay themselves a salary either. All the profit is essentially theirs, subject to SE tax, and they take draws which aren't deductible.
Okay, what about other perks like health insurance, qualifying fringe benefits for owners? How do those work?
Good question, because this is another area with big differences. Let's start with a partnership. Fringe benefits paid for partners, like health insurance premiums, are typically treated as guaranteed payments, so deductible by the partnership. But they're taxable to the partner as ordinary income, subject to SE tax. The partner might get an above-the-line deduction for health insurance on their 1040, but the benefit itself isn't excluded from income initially.
Okay, so taxable to the partner. What about corporations?
Here's where corporations often shine. For a C corporation, qualifying fringe benefits paid for shareholder employees, things like health insurance, group term life insurance up to $50K. Some others are deductible by the corporation. And crucially, they are generally non-taxable to the shareholder employees. They don't have to include the value in their income.
That's a huge perk. Tax-free health insurance paid by the company.
It can be a very significant benefit, yes.
And S corporations, are they like C Corp here?
Mostly, but with a major catch. For an S corporation, these benefits are also deductible by the corporation. However, they are only non-taxable if the shareholder employee owns 2% or less of the S corporation's stock.
Only 2% or less. What if they own more, which most owner-operators do?
If they own more than 2%, those fringe benefits become taxable to them, similar to how they are for partners. The S Corp still gets the deduction, but the owner picks up the income.
Wow. Okay, so that 2% rule is a big deal for S Corp owners wanting benefits.
It really is. It makes C Corp look much more attractive from a pure fringe benefit perspective for owner.
So connecting this all together, it sounds like both C and S corporations offer some distinct advantages when it comes to compensating owners compared to partnerships.
They absolutely do in certain ways. Advantage 1. Corporations can deduct the employer portion of FICA on shareholder employee salaries. Partnerships don't get that break on guaranteed payments. Advantage 2. Those potentially non-taxable fringe benefits, especially for C Corp shareholder employees, and also for S Corp folks owning 2% or less. That's a big contrast with partners and majority S Corp owners where those benefits are generally taxable.
Let's apply this. Example 3. Don and Mary again. Active owners, expecting profits. They want to receive reasonable compensation and fringe benefits like health insurance, but they don't plan to take other distributions beyond that.
Okay, compensation and benefits, no other distributions, expecting profits. In this specific scenario, a C corporation is often the most advantageous.
Why the C Corp here?
Couple reasons. First, the C Corp can pay Don and Mary a salary, and the corporation picks up half the FICA tab plus gets the deduction. Second, and maybe more importantly here, the qualified fringe benefits, like their health insurance, are completely non-taxable to Don and Mary as C Corp shareholder employees. The corporation deducts all these costs, salary, employer FICA, benefits reducing its taxable income, which is then taxed at that relatively low 21% corporate rate. If their individual rates are higher, this looks good.
And why not an S Corp or partnership?
Well, with an S Corp, since Don and Mary each own 50%, way more than 2%, those fringe benefits like health insurance would become taxable income to them, less ideal. And in a partnership, they'd get guaranteed payments, have to pay the full self-employment tax on them, and the fringe benefits would also be taxable. So the C Corp structure often works out best when significant tax-free fringe benefits are a major goal alongside salary.
Got it. Okay, let's move from paying yourself for work to just taking money out. Those everyday operating distributions while the business is running. This can look really different depending on the entity, right? Can have some surprising tax hits.
Absolutely. How you pull cash or property out midstream is governed by very different rules. Let's start with C corporation operating distributions. Generally, when a C Corp distributes cash or property to its shareholders, it's treated as a taxable dividend, but only to the extent the corporation has current or accumulated earnings and profits, E&P. Think of E&P as a corporation's pool of taxable income over time.
So if there's E&P, the distribution as a dividend, taxed at those 0%, 15%, 20% rates we talked about?
Correct, plus the potential 3.8% II tax for higher income shareholders. If a distribution exceeds the E&P, it's then treated as a tax-free return of capital up to the shareholder stock basis. Anything beyond basis is capital gain.
What if the C Corp distributes property instead of cash? Like gives a shareholder a building?
Property distributions from C Corp get complicated. The amount of the distribution to the shareholder is the property's fair market value, FMV. And the C Corp itself has to recognize a gain as if it sold the property for FMV if the property has appreciated in value. That gain is taxed at the corporate level. They generally don't recognize losses on non-liquidating distributions, though.
Wow, so another potential layer of tax even on just distributing property.
Yes, the corporation recognizes gain on appreciated property distributions. The shareholder gets a taxable dividend equal to the FMV, assuming E&P, and takes an FMV basis in the property. It can be tax inefficient.
Okay, not ideal. How about S Corporation operating distributions? Are they simpler? Less tax?
Often, yes, but they have their own set of ordering rules. Generally, S-Corp distributions are non-taxable first. They come out of the S-Corp's Accumulated Adjustments Account, or AAA, which tracks previously taxed S-Corp earnings. These reduce the shareholder's stock basis.
So tax-free up to previously taxed income and basis.
Largely, yes. If the distribution exceeds the AAA, then it might be treated as a taxable dividend, but only if the S-Corp used to be a C-Corp and still has some leftover C-Corp E&P. After any C Corp E&P is cleared, distributions are again non-taxable return of capital up to any remaining stock basis. Only distributions in excess of basis are taxed to the shareholder, usually as capital gain. So often less immediate tax than C Corp dividends.
What about S Corp property distributions? Same issue as C Corp.
Similar treatment on the gain recognition. If an S Corp distributes appreciated property, the S Corp recognizes a gain just like a C Corp. But because it's an S-Corp, that gain isn't taxed at the corporate level. Instead, it flows through and is taxed directly to the shareholders, increasing their basis. The distribution itself is then generally tax-free up to that new, higher basis. Still, gain recognition happens.
Okay, gain recognition seems to be a theme with corporate property distributions. What about partnership operating distributions? Are they the promised land here?
They often are, yes. Partnership distributions are generally much more tax-friendly. Cash distributions are typically non-taxable to the partner, simply reducing their basis in the partnership interest.
Only taxable if?
Only cash distributed in excess of the partner's outside basis is taxed, usually as capital gain.
and property distributions from a partnership.
This is the huge advantage. When a partnership distributes property, generally no gain or loss is recognized by either the partnership or the partner.
No gain recognized.
Yeah.
Even on appreciated property.
Correct. The distribution is generally non-taxable to the partner. It just reduces their basis. The partner usually takes the property with the partnership's adjusted basis, a carryover basis, up to their basis in the partnership interest. Much, much simpler and less taxing than corporate property distributions.
And sole proprietorships, taking money out.
For sole proprietorships, it's the simplest of all. Withdrawals of cash or property by the owner are just not a taxable event. It's already considered their money. They just take it. No gain, no dividends, nothing.
Okay, so pulling all that together, if you plan to regularly take money or property out of the business while it's running, which entity usually makes the most sense purely from that distribution tax perspective?
This raises that important question. If regular distributions are part of the plan, which structure minimizes the tax friction? The partnership form, including LLCs taxed as partnerships, is generally favored, especially if you might distribute appreciated property.
Why again? Remind me.
Two big reasons. One, no gain recognized by the partnership on distributing appreciated property. That avoids a whole layer of tax that corporations face. Two, distributions are generally non-taxable to the partner up to their basis, and partner basis tends to be higher than S-Corp stock basis because it includes that share of partnership debt. This means more capacity for tax-free distributions.
Compared to C-Corp with taxable dividends and corporate gain on property.
And S-Corp, which also recognize gain on appreciated property, even if it flows through. Yeah, partnerships generally win on operating distributions.
All right, let's jump to the end game. Imagine the day comes, you're ready to close up shop, liquidate the business, distribute all the remaining assets. The way you do this final distribution can also have significant tax costs, right? How does that final tax bill look for C corporation liquidating distributions?
Yeah, liquidation is another area with major differences. For C corporation liquidating distributions, you again potentially face two layers of tax. It's often called the double tax on liquidation. First, the C corp itself generally recognizes gain or loss on all its assets as if it sold them for fair market value when they're distributed.
So tax at the corporate level on any appreciation.
Exactly. Gain is taxed at the 21% rate, and losses can offset gains. Second, the shareholders treat the liquidation like selling your stock. They recognize a capital gain or loss equal to the difference between the FMV of the property they receive and their basis in the C Corp stock.
Double tax again. Ouch. And S corporation liquidating distributions. Is it the same painful story?
Largely, yes. It's treated much the same as a C Corp liquidation in terms of gain loss recognition. The S Corp recognizes gain or loss on its distributed assets as if sold at FMV. That gain or loss then flows through to the shareholders, adjusting their stock basis. Then, the shareholders recognize capital gain or loss based on the difference between the FMV of what they receive and their now adjusted stock basis. So still potentially 2 points where gain is recognized, even if the first one flows through.
Okay, so corporations seem to trigger gain recognition at the entity level on liquidation. What about partnership liquidating distributions? Is there a different, maybe better approach?
Yes, significantly different and often much better, especially with appreciated assets. This is another huge potential advantage for partnerships. In a partnership liquidation, generally no gain or loss is recognized by the partnership itself when it distributes assets.
Again, no entity-level gain.
Correct. And the partners generally don't recognize gain either, unless the cash they receive exceeds their basis in the partnership interest. If they receive property, their basis in the partnership interest basically gets assigned or allocated to the assets they receive. Gain or loss is typically deferred until they eventually sell those distributed assets.
So way more tax deferral potential with a partnership liquidation.
Absolutely. It avoids that immediate entity-level tax that corporations face on appreciated assets during liquidation.
So what's the strategic takeaway here? When liquidation looms, which entity is better?
Well, what's fascinating here is how the best choice really depends on whether your business assets have gone up or down in value. The tax rules strongly favor partnerships if the entity owns primarily appreciated gain property. Why? Because you avoid that entity-level gain recognition on liquidation. Big tax saving. However, the rules tend to favor corporations, C or S, if the entity owns primarily depreciated loss property. Why? Because the corporation can recognize those losses upon liquidation, which can offset gains or potentially flow through in an S-Corp. Partnerships generally can't recognize those losses at the entity level upon liquidation.
Interesting twist. So gains favor partnerships, Losses favor corporations for liquidation.
Generally speaking, yes.
Let's try example 4 with Don and Mary. They're forming a business for rental real estate, a passive activity. They expect the properties to appreciate substantially over time. They're really concerned about the tax hit when they eventually liquidate decades down the road.
Okay, rental real estate, expecting lots of appreciation, worried about liquidation tax. In this scenario, a partnership, or an LLC taxed as one, is by far the most advantageous structure.
Because of that appreciation.
Exactly. If it's organized as a partnership, when they eventually liquidate and distribute those highly appreciated properties, the partnership itself recognizes no gain. And Don and Mary generally won't recognize gain either unless the cash exceeds basis. They'll take the properties with a basis derived from their partnership interest basis. Tax is deferred. Contrast that with a C or S corporation holding that same appreciated real estate. Upon liquidation, the corporation would recognize gain on the property distribution, triggering corporate tax for a C corp, or a flow-through gain for an S corp, and Don and Mary would likely recognize capital gain on their stock, too. Potentially a massive tax difference on liquidation.
That really drives home how the expected future of the assets impacts the initial choice. Okay, one last big area. What if you make a choice now? But down the road, things change. Your business evolves, the tax laws change. Can you switch entity types? And crucially, what's the tax cost of changing your mind? Let's start with converting from a flow-through entity to a C corporation. How easy or hard is that?
That's a fantastic practical question. Businesses definitely evolve, generally shifting from a flow-through entity like an S-corp, partnership, or sole prop to a C corporation structure is relatively straightforward and often tax-free. Well, if you're an S-corp, you can simply revoke your S election. Boom, you're a C-corp going forward. Though remember, you generally can't switch back to S status easily for 5 years. If you're a partnership or sole proprietorship or an LLC taxed as one, you can often use that check-the-box election we mentioned earlier to just elect C corporation tax status. Or you could form a brand new C corp and contribute the assets of the old business into it in exchange for stock, likely qualifying under that tax-free Section 351 rule if the owners maintain control. So usually not too painful tax-wise.
Okay, so going to C corp status seems reasonably flexible. But what about the reverse? Converting from a C corporation to a flow-through entity, is that where the trouble starts?
Ah, yes. Here's the crucial warning sign. Going from a C corporation to a flow-through entity, like an S corp or partnership LLC, can be much more complex and, frankly, can carry potentially significant tax costs.
Why is that so much harder?
Well, a C corp can elect S corporation status, assuming it meets all the eligibility rules, like number and type of shareholders. That's one path. But converting a C corp to a partnership or sole proprietorship or an LLC taxed that way, this often involves what the IRS treats as a taxable liquidation of the C corporation.
The liquidation we just talked about, with the double tax potential.
Exactly. The IRS basically says, okay, to become a partnership, the C corp must first distribute all its assets out to its shareholders. This means the C corp is deemed to have sold all its assets at fair market value, triggering corporate-level gain or loss. Then the shareholders are deemed to have received those assets in exchange for their stock, triggering shareholder-level capital gain or loss.
Yikes. So just changing tax status could trigger a massive immediate tax bill as if you sold the whole company.
It absolutely can. That deemed liquidation is the kicker that makes converting out of C corp status potentially very expensive, especially if the corporation holds appreciated assets.
So it really sounds like that upfront decision carries a lot of weight, because unwinding a C corp structure later can be incredibly costly from a tax perspective.
Precisely. If we connect this to the bigger picture, the key takeaway is that moving from flow through to C corp is generally much simpler and less costly than going the other way. It's almost like a one-way street, or at least a street with a very, very expensive U-turn fee if you start as a C corp and want to become a partnership later. Something to really consider upfront.
Wow. Okay, that was truly a deep dive. I mean, it is crystal clear now that choosing a business entity is so much more nuanced than just, picking a name off a list. It impacts absolutely everything: how you put assets in, how you take money out, how you pay yourself, how you handle losses, and even how you eventually close the doors.
It really does. And this raises, I think, an important question for you, the listener, to ponder. Considering your own long-term business goals, are you aiming for rapid growth and retaining earnings? Are you looking for steady income distributions? Or is the big goal an eventual sale or liquidation? thinking about those goals, which of these tax characteristics that we've discussed, contribution rules, operating taxes, losses, compensation, distributions, liquidation, conversion, which ones do you think would be the most critical for your specific decision and why? The answer might actually surprise you once you start layering all these variables onto your unique situation and plans.
That is a fantastic, powerful thought to leave us with. It really drives home that this isn't just about minimizing this year's tax bill, but about strategic planning for the entire life cycle of the business.
Yeah.
There's just so much to consider. We really hope this deep dive has given you a much clearer picture and maybe some of those aha moments. Thanks so much for joining us for this deep dive. Keep learning, keep exploring those details, and we'll see you next time.